Small caps are near 40-year lows relative to large cap. The challenge with valuation is you need a catalyst. And right now, particularly small caps, we're searching for that catalyst. We're searching for an improvement in the M&A environment, business execution as seen through earnings growth. That's what we really need to see to start to unlock the value that's unquestionably there.
After Trump's electoral victory, the Russell 2000, a major small cap index, shot higher on the expectation that sort of the Trump agenda would benefit small caps because, small cap companies in the US generally are more domestically focused, and that means they're not as sensitive to the tariffs, but it hasn't really panned out like that.
Over the past 2 years, large cap companies, valued at over $10 billion and generally considered less risky, have significantly outperformed small cap companies, which have a market cap below $2 billion and are generally more volatile. The Russell 2000 index, which tracks small cap stocks, dropped 10% in the first quarter of 2025, its worst quarterly performance since 2022. It's also down over 20% since the inauguration, marking its worst performance for the first 75 days of a presidential term in history.
You think of these small companies as being nimble and be able to grow faster and so forth, but the reality is that they have not been able to navigate the macro landscape very effectively the last couple of years, and that continues in the most recent quarter. Large cap companies grew earnings on the nature of 12 to 15%, and small cap earnings were roughly flat.
Many small cap companies rely on borrowing to fund their operations. About 45% of the Russell 2000 index depends on floating rate debt, compared to just 9% of the S&P 500. Since floating rate debt is linked to benchmark rates, like the federal funds rate, borrowing stays expensive when interest rates remain high.
The average small cap company is more leveraged than a large cap company, and on average, that debt tends to be much shorter term in nature, i.e. it needs to be rolled over sooner rather than later. As rates were rising in 21, 22, into 23, that was a real challenge for small cap companies. They were coming in at much higher interest rates and seeing their debt expense rise quickly. Now we're poised to be on the other side of that mountain. There's the opportunity to reprice that debt at lower levels. Challenge is, why are rates not falling? The Fed has unquestionably very tight policy right now. There's the odds of a recession are higher today by a good amount relative to 3 months ago.
With the probability of a recession rising as high as 60% from 20% this year, some small cap sectors are more likely to withstand market turmoil.
And so in that environment, the only parts of small cap that offer some opportunity are probably things like utilities and staples. On the other hand, if the macro environment, concerns pass, then I think there's going to be really attractive opportunities, particularly in the healthcare area, a little bit in the consumer discretionary area.
A lot of investors are looking for the next big thing in tech. And one place to do that is in the small cap space, where a handful of companies that are associated with the whole quantum computing revolution have really seen quite a bit of activity lately. These stocks are essentially meme stocks. These are companies like Rigetti Computing that really took off. The risk-reward payoff here is certainly still slanted towards risk, but I think that the possibility of a huge return later down the road is keeping a lot of investors engaged with these stocks.
Usually the boogeyman comes from someplace you're not expecting, and right now tariffs and inflation-related concerns are the most popular areas. With the valuation spreads where they are, I think that the odds are on your side. It's a very attractive setup in the small cap land.